This week, we continue with our focus on the Superdogs Portfolio. Cobie, over to you.
Okay, and anyway, we looked at this portfolio last week, and if you look at the screen, just a quick recap there. The managers, Adrian Saville and Andrew Ditburner. All the rest of the factors are on screen there. Just give you performance numbers again. 12 months, 11.9 versus 14.5. 24 months, 19.3 versus 16.9. Now remember, this portfolio uses a three-factor model. It uses price-to-earnings ratios, it uses dividend yields, and it uses price-to-book in order to find those companies that are the most unloved. So let's maybe just have a look at some of the stock picks in this portfolio and look at how unloved they really are. Now, if you look at this specific chart over here, we're looking at the three stock comparison against the FINDI. You remember that the FINDI is actually the benchmark for this fund. It excludes the resi, so it's only financials and industrials. Now, if we look at it from a price to earnings perspective, the financials and industrial index is the red line that you're seeing running at the top of the screen. When was the purchase date for this fund relative to the three stocks that I'm showing over here? It's roughly basically in the middle of your screen. The three stocks that I'm showing you over here is Cadiz, which is the black line, Grindrod, which is this line over here, and Basil Reed, which is the yellow line that you're seeing running right at the bottom of the screen. And you can see that the FINDI is much more expensive than all three of these companies. As a matter of fact, all three of these companies in their last reporting period actually had less earnings than in the previous period. So from a price to earnings perspective, yes, it's doing exactly what Adrian and them wanted to do. Okay, so let's have a look at maybe at the second factor, which is the dividend yield. Now remember, higher dividend yields are better than low dividend yields. Again, you see the FINDI, which is the benchmark right at the bottom of the screen. Again, the purchase date for these three stocks would have been somewhere in the middle of your screen. And if you have a look at them, you'll see that Cadiz, actually you're buying off a far higher dividend yield than what you're buying the FINDI. Getting a lot of benefit for buying the stock. As a matter of fact, they would have bought the stock on a dividend yield of about 6%. Interesting to see how it starts jumping towards the 2011 period. The other two stocks, which is Basil Reed and Grindrod, are just marginally ahead of the FINDI. Again, on that score, it's doing exactly what it's supposed to do. The third factor is price to book. And quite frankly, price to book is the price you're paying relative to the book value of the company, the breakup value, so to speak. Let's just look at that in a table format. FINDI, price to book ratio of 2.2 as the complete index. Cadiz 1.1, Basil Reed 1, and Grindrod 1.4. Exactly there, it complies as well. Adrian, over to you.
Okay, so Adrian, we know that it was actually an experiment, the Superdogs portfolio. Is that right?
Yeah, well, it started as an academic exercise, sort of pondering what would happen if I bought profitable but very unloved companies. The companies must be profitable. That profit is a proxy, not just for the fact that the company is able to earn money, but increasingly that this is a good business. So in essence, what the academic exercise went in search of was for well-run, profitable but unloved companies.
And definitely, I mean, Grindrod and Basil Reed, and in fact, Cadiz as well. But from a dividend yield perspective, we know that, in fact, the stocks that you've picked, especially when the portfolio was put together, we saw a much higher dividend yield. But I see that Grindrod and Basil Reed are actually starting, or Basil Reed definitely below the FINDI's dividend yield, and Grindrod now matching it. Yeah,
that's a function of, well, it's actually a function in recent times of two things. Grindrod recently, you've seen the share price appreciate relative to the market, so that's going to make any dividend yield look less attractive, or the price earnings look more demanding. But you don't want to look past the fact that both Grindrod and Basil Reed have been under earnings pressure, and that has made the ratings less compelling.
So, Cobie, tell us about your stock picks here, how you picked these particular stocks out of the Superdogs portfolio.
Well, remember again, and I think Adrian needs to just come in here if I get this wrong, but remember what it's trying to do, this portfolio, is it's trying to make at least a stock pick in every one of the sectors, and maybe at the super sector level. So it's trying to give you a diversified portfolio across the FINDI. Now, the reason why I chose these three is because it just again shows what the benefit is of the portfolio, and exactly how these kind of operate. In certain cases, there are some stocks which, from a dividend yield perspective today, obviously is less than what it was before, but that's just again relative to the actual purchase price and where it is relative to that. Remember, the starting date here is in September 2010. The academic study used to run between Jan and December, whereas this is from September to September. So expect a reset, well, actually quite soon, for this portfolio.
Yes. You also want to not just focus on single companies, because I think this is the key to any portfolio approach. Is it would be naive to imagine that you're going to get every single stock right, and this is at the heart of the portfolio approach. So the companies that you're looking at here, two have done reasonably well. Cobie's actually has done very well, and that good performance has been helped by the value unlock, or the catalyst, which was the announcement for part of the acquisition of part of their business, and you've seen the share price ramp up quite materially in the last few months. But if we put the entire portfolio together, what this portfolio shows you is a dividend yield that is about twice the current market dividend yield.
Are you happy with the benchmark, Roland?
Well, I mean, one thing one can maybe ask Adrian is, it tends to sound like a small cap value kind of bias.
Yeah.
Now, the potential issues that you probably qualitatively filter are things like liquidity risk and maybe higher volatility, because you're looking at cheap stocks that are quite small potentially, because large companies will never be right at the bottom of a ranking. They tend to be somewhere in the middle, right?
You're not allowed to use the word cheap.
Undervalued. Undervalued.
Exactly.
Sorry.
Yeah, cheap implies junk. These are companies where the value isn't being recognized. And but the other components that you flag are absolutely critical. You want to be cautious of risks such as liquidity risk, volatility risk. You suggest that the portfolio biases in the direction
Is it
of
a small cap?
value. Well, it's definitely a very clear value bias, but what that does is it tends to tip you in the direction of small or mid cap also. However, that's not always the case. If you cast your mind back to the late 1990s or parts of the whiz-bang years of the noughties, there were times when the mids and smalls got very expensive relative to large. So this doesn't have a structural or inbuilt predisposition to find just mids and smalls. If there are large cap stocks that satisfy the criteria, they will comfortably be included in the portfolio.
But will they be at the bottom of the ranking?
Bottom of the ranking in terms of?
Of the metrics, PE, dividend yield?
Not at all.
As in the dogs rather than the...
No, it'll depend on the particular time that you're looking at. And right now, for instance, there is a substantial overweight to mids and smalls, but there are some large cap names in the portfolio.
Adrian, did you commit any of the sins within this portfolio? All cards on the table now. Because I know it was an experiment, as you alluded to a little earlier, but tell us about the process when it came to picking these stocks, apart from the value metric.
If anything, in putting the portfolio together, when I first put it together 13 years ago, it highlights the naivety that I was building it with. And I was like, well, I wonder what would happen if I just used a small set of factors. And it was almost like, well, let's see what happens. Who would be this naive? Who would be this innocent that they could possibly build a portfolio? And 14 years on, this is a very powerful result in my view.
Fantastic.
Immediate split between opinion and fundamentals. So if you understand what fundamentals drive markets, then it doesn't matter what the opinion is, it becomes like a mechanical process. It's probably one of the most difficult things for investment teams is to mechanically, especially in a bear market, just before a bear market, to mechanically go and say, look, we should be owning less equities. We should be doing something else with capital because it's just getting too expensive.
It's too much of an emotional game, especially when there's money involved and greed and potential losses. We have to leave it there. Gentlemen, thank you so much for joining me. Great to have you on the program.